Yeah, what's going on with the baseball season? Will there be fall ball? Because the Big Ten just canceled the all sports.
Yeah, they're phasing us in. So we're doing right now we're in like a down period. We had 2 weeks where we can't really do anything, and then I think the 24th we're starting up just like small individual like less than 10 people practices, um,
Okay,
and then if that goes well, um, if that goes well, then we'll move to I think like half team, like full pitchers, full infield, and then if that works for, I think the shortest amount of time to get to team practice is 6 weeks, and
right.
the longest would be I think 3 months. So we'd start in early November, and then the semester is pretty much over.
Yeah, and it's cold in November playing baseball.
Yeah, I'm not sure where we're gonna get access, but hopefully it goes well and we're on the field as a team. Like I don't know.
George, welcome.
Hi, how are you?
Good. How are you doing?
Pretty good.
Okay, we'll just wait for everybody to assemble and take a quick attendance, and we'll get started. George, where are you calling in from?
So I'm calling in from the Clove Apartments in New Rochelle, but I'm from Orlando, Florida. So I just moved
Ah,
up here. Yeah.
well, I think New York is in a little bit better shape than Florida is right now with COVID, I guess.
A much better shape. Yeah, my mom's always telling me stories of how restricting it's getting down there because it's a crazy outbreak.
Because it has to be. Yep.
Yeah. How have you been during Corona?
Good. I mean, I'm getting a little sick of working from home, but it is what it is.
I can tell
Mackenzie, welcome. I think Mackenzie Meisner is on. Meixner. Well, I'll have you uh, introduce yourselves later, and you can tell me exactly how to say everyone's name. Welcome, Mackenzie. You just want to test your mic.
Hi, how are you?
Perfect. Great. Coming through loud and clear.
I can already tell you have a much better setup than most other professors.
Oh, really?
Yes.
Well, I've become a little bit of a Zoom expert, although I've screwed up. Last semester, I kept screwing up the breakout rooms. Um, but we'll be in person, so um, I won't have a chance. I'll eventually learn how to use them properly, but yeah, I think a lot of professors had some trouble going virtual. It wasn't easy. It just takes a lot of time.
Yeah, it's I mean, it's difficult for everyone. I did not even know what Zoom was before we started.
Oh, now I can't live without it. Let me just see if anybody else is. Oh, Liam, welcome.
Hi.
Brogan, I think, has just joined. Here he comes. Yeah, this is actually JT. This is actually a smaller class than we had for global finance. I think this will be 15 students.
15.
Yeah, so we'll. It won't be like 27 people. Darren, welcome. So you're like half the class has arrived. We'll just wait for everybody else. And if you hit the participant icon at the bottom, you'll see everybody. And in case you want to give me some information, like slow down, you should be able to raise your hand. You can clap for me. As you can see, I'm clapping for myself. Thumbs up, thumbs down. Hi, Stephanie. Omar, how are you?
Hello, can you hear me?
I can hear you fine. Where are you? Gabrielle.
How are you? How's everything?
I'm doing good. Where are you calling from?
I'm at the off-campus apartments
Oh, nice.
on the
All right.
roof. On the roof.
That's a good way to take a class.
I'm in the gym over here. The gym's with me too.
Oh, tell him I said hi.
Yo, Professor Kushner says hi.
You
From last semester.
are you guys what's going on with soccer?
It's me, Najim.
Hey, how you doing, Najim? Good to see you, man.
How are you?
I'm doing great. You should take this class.
You said if you need the class, take the class.
What class?
Finance 3, what is it?
329.
Yeah, 329.
Okay, since you guys were on time, let's begin. And as other people arrive, I will let them in. So this is financial institutions and markets. This is, I think, going to be Danny is coming in. I think this is going to be a class you're really going to enjoy. If you are interested in the financial services industry, this is a class that I think will serve you well when you're interviewing, as well as helping you understand potential jobs for you to pursue. It's a class that I've had a lot of experience in my professional life. I've spent 30 years on Wall Street, and this is a fun class because you're going to learn stuff. Maybe there's a little bit of jargon, but this is meant to be really practical for all of you. So this is sort of the run of show tonight. I'll introduce myself. I'll tell you a little bit about how this class will progress. And then I really do want to get to know who you are. And we only have 15 students in class this semester. So I expect that we'll get to know each other really well. And then I'll take you through the first lecture, which is introductory in nature. So who am I? I'm Tom Kushner. Don't hold it against me, but I went to Fairfield University. That's where my heart is. And I can't wait for the day when Fairfield can beat the Gales in basketball. It hasn't happened since I last can remember. I got my MBA at the University of Michigan in Ann Arbor, and then I recently finished my doctorate at Sacred Heart University here in Connecticut. And so as you can see, I've been in the financial services industry since 1986. Currently, I'm at Wells Fargo Securities, and I'm a senior relationship manager for our investment bank, and I cover our largest institutional clients. Some of those clients will actually be joining us as guest lecturers throughout the semester. I'm married with 3 kids. My oldest daughter lives in London. She works for BlackRock, a big financial asset manager. I have a son who just graduated from WashU in St. Louis, and our youngest daughter is going to be a senior at Emory in Atlanta. And for activities, I'm a board member of a couple of nonprofits. I'm the chief fundraiser for Joe Torre's Safe at Home Foundation. I sit on an organization called the Achievement Foundation that gives out grants to organizations affiliated with Junior Achievement, a business youth organization. I sit on my undergrad business school advisory board, and I mentor veterans through the American Corporate Partners. And this is a class I get really excited about teaching because I think it's really fun and really interesting, and I hope you will too. So just the mode of instruction for this semester. Obviously, you've got the Financial Institution Markets and Money book. It's a new book. We used a pretty basic book last semester, and this is a much better book. I think it's understandable, and it's really action-packed with lots of really good information about financial markets, financial institutions, and sort of interest rates and money. I also, for I think Stephanie and Omar and JT, who have taken me before, I use Kahoot, so please load it onto your iPhone. And I use Kahoot so that after every lecture, the following lecture, I'll do a quick survey on some of the topics that I think are important from the previous lecture, so that you'll always be reminded of the things that I think are important that we're talking about. And why that's important is because I'll probably cover it on the test. And then I'll take you through Blackboard in a second, because I do want to just go through some of the stuff in the class. So let's see if I can now move to Blackboard. Where's Blackboard? No. I did open my Blackboard earlier. Give me a second. Okay. Here we go. Oh, of course nope, it's my personal, here you go. So as you're familiar with Blackboard, I've put this tab here so that if you ever just need to launch the classes, I'll send you reminders. If for any reason you are going to be virtual, you can just launch the Zoom classes from this tab. Here's the syllabus, which we'll talk about in a second. I've also loaded up the calendar just to make it a little bit easier for you to understand what we're going to be doing each class, and what's going to be happening. So I'll get into it in a little bit, but each week for the first, I think it's 7 or 8 weeks, you'll be doing journal presentations and journal submissions on different markets, which I'll be assigning to you, and I'll show you those assignments in a few minutes. And so you can just key on. So next week, Gabriella, George, Michael, Liam, and Christian will be responsible for presenting to the class on their journal presentations. And we'll go on that when we get back to the main slides in a second. You can also here find what we're going to be studying. We're going to be talking about the Federal Reserve and the conduct of monetary policy and interest rates next week. And as you can see, I've embedded also, just in case you don't know where to look, the details for the Zoom meeting there. And then just a reminder to submit your journal submission if you're not presenting. If you go down, you'll also see that on some classes, there'll be a guest lecturer, and you'll see who is going to be speaking for the first half hour of class and what the topic they'll be discussing. And then I have a little bio so you can better understand who's talking to us. In terms of course content, every week after each lecture, I will load my PowerPoint lecture. I'm also taping this lecture, so I will, if for some reason you're sick or you can't make it, and you want to listen in, you'll go to this tab for lecture replays. There's a tab for guest lecturers. Here are their bios. And if they present any PowerPoints, I'll load them there as well. And then there's a file for Kahoot. So after every Kahoot, sort of, it's a little fun sort of. It's not a test, but it's a fun review of the previous class. I will load that Kahoot session so you can see the questions and the answers. I'm not quite sure. I may do one discussion topic this semester. I haven't decided yet, but that would obviously be a class participation grade. We'll talk about grades in a second. And then here's assignments, and we'll talk more about this. As I said, it's the first 6 classes. You'll be submitting a 1-page, very succinct description on the markets that I'm going to assign you, and you'll see that in a few minutes. And that's where you'll submit them here. And then there's more information on the semester-long project, which we're going to talk about in a second in that folder. And that is sort of Blackboard. Let's go back to lecture 1. Yep. All right, so you all see the PowerPoint. Here's the class expectations. Listen, this is a college class, so I've got to give tests, right? But I've sort of oriented grading to ensure that the outcome is that you learn something, and that you learn something that you might use if you pursue a career in financial services. But it's also important lessons in life, in my view. So there'll be 3 exams. There'll be 50% of your grade. They will be non-cumulative. The highest score you'll get will be worth 20%, and the other 2 will be worth 30%. So 15 each. Tests are open note. I allow 2 pages of notes, and all the questions will come from either the text, from 2 readings that I will assign for class, and PowerPoints. And right now, I believe that the test will be remote access, so you'll be able to access it on Blackboard at 6:30 on the Tuesday night of the exam. 30% of your grade. So then the other 50% is really in your hands. It's about class participation. The semester-long project, I bifurcated it. The first half, you'll succinctly write up a topic that we'll talk about in a second. And then 5 students will present the second half of class after the break on their topics. And then we'll stop. Then you won't, after those 7 classes, there won't be any more weekly submissions. The second half of the semester, you'll be working on your presentation, which you're going to give to the class on a financial crises that I will assign. I plan on giving 2 homeworks, short homeworks. The homeworks really are just to reinforce some issues that I think are really important in the class, that I know I'm going to be asking similar questions on the tests. So it's in your best interest to really understand them. And then class participation, which is going to be asking questions, and not only asking questions to me, but when students present in each class, you'll have a chance to ask them questions. So it's important for a couple of reasons. One, I hope that this sort of a derivative impact of this class is that you learn how to get comfortable giving presentations and in front of an audience. It's going to happen when you get out into the world of work, and it's also I hope it's also good training ground for answering questions that people may pose from the class. So here, the first half project topic assignments. You're each going to be assigned a market. So there are 5 markets: the mortgage-backed bond market, the corporate bond market, or sometimes called the credit markets, U.S. Treasury bonds, Treasury market, municipal bond market, or the muni market, and U.S. equities. So next week, Gabriella will do a presentation. Gabriella, JT, Elvis, Gabriella. So Gabriella, JT, and Elvis are in charge of mortgage-backed bonds. George, Brogan, and Danny are focused on corporate bonds. Michael, Darren, and Brandon are on the U.S. Treasury market, the largest market in the world. Liam, Mackenzie, and Omar are focused on the muni market, and Christian, Jonathan, and Stephanie are focused on the U.S. equities market. So students that have had me before understand that every week you submit a succinct one-pager on what has happened in those markets, and I'll load onto Blackboard some resources you can go to collect information, and I'll want to understand, what you think of these markets, and if the trend, what's impacting the trends, why are they moving in a certain way, what's moving them, and your personal views. But these dates, so August 18 next week, Gabriella, George, Michael, Liam, and Christian will be responsible for getting up at the second half of the class and discussing these markets. So the first week really is all about educating all of us on what these markets are. So for August 18th, what I expect is you will define what these markets are. You might talk about how big they are. In fact, I'm going to show you a slide that you can steal to underscore how big these markets are, and they're big. You're going to talk about what potentially moves them, why they are, why they exist. So for the first week, you're just going to help define what these markets are, and then every week after, you're going to tell me what's happened in the market, and then we can have a discussion about if it was expected or it wasn't expected, or if it was if it's consistent with the underlying economic activity of the country. So again, there'll be more information on Blackboard about these assignments, and my hope is that one, you'll understand these markets a lot better because you're reading about them and having to write just a one-pager. If you want to add a chart or two, please do, and then you'll get very comfortable talking in public. The second half, so again, that's only for the first 6 weeks of class. We'll give you one class that you don't have to do anything. And the second half of the semester is we're going to focus on financial crises. And so as you can see, on October 6th, Gabriella, you're going to be doing a presentation on the gold panic of 1869. And in the syllabus, which we'll go back to in a second, it will dovetail what I'm looking for. In fact, why don't I go back to the syllabus? So again, here's the syllabus. We're in LaPenta 101. By the way, since we're only 15 students, and I think 1 or 2 on any given day will probably be joining us remotely, we'll all be able to be in that class because it's a big enough class. You must wear a, oh, I'm not sharing this, I apologize. Can you see this? Okay, sorry. Here you are. So again, we're in LaPenta 101, which is a big enough class, so we'll all be welcome there. You must wear a mask, and you have to show me your Gale Cares app that you have a green pass when you come into class. Again, this is all pretty normal. If you're experiencing any symptoms, you should take the class remotely. You are expected to sit in the same assigned seating. I'm not going to have a lot of people coming up to the front of the class for their presentations. I don't know if you've been in class yet. There are these, actually you haven't, but there are these things called the OWL system. So you can just stand at your desk and you can present at your desk. The people who are attending virtually will hear you and see you because the OWL camera will track you. And then everybody can ask questions. No eating or drinking in the class. We have to maintain social distancing. We're not going to be sharing any class materials. I'm big on, I have been big on sort of group discussions. So I'm gonna have to figure out how to do that in class and be respectful of the requirements for social distance. If you want to attend remotely, you can attend remotely anytime. I'll be taking attendance each class. You know, I like to see people's face on Zoom, so please keep your your video on. Thank you, Danny. And you know, if you can just remain. Somebody is telling me that their Zoom link is not working. So give me 1 second here.
My link didn't work either. I had to do it on my phone.
Really?
On Blackboard.
All right. I'm just gonna tell them to go through Blackboard.
I just put something in the chat. I just had a quick question. I'm sorry.
Yeah.
Are we not even allowed to bring water into class, or is that allowed? Or that's not even allowed?
You know, it's a really good question. I will bring water because I need to, but I'm sure,
Okay.
Gabrielle, I'm sure that'll be fine.
Okay, thank you.
But let me just figure out on the fly here what. Let me see if I can help the student real quick. And what is our, I forget what my Zoom session number is. Well, let me look it up. All right. Hopefully he'll be in here. Okay, we're in the syllabus. Okay. Obviously, we talked about class expectations. Class participation is a big thing. Test policies, I'm planning on giving them over Blackboard. So I'll trust that you have 2 pages of notes. Here are the semester-long projects. You know, again, you'll be learning about these markets. So I think by covering them each week, it'll just reinforce what they're all about. And you'll get comfortable speaking in front of a class, as well as responding to Q&A and writing succinctly. Here are the second half topics. These topics, what I want is sort of, you know, the crises definition, what the origins of that crises were, a timeline, the sort of macroeconomic impact, institutional and market impact. What were the policy response by the government or the Federal Reserve, and any lessons learned and any other relevant information. And as you can see, I've also included the 2020 COVID-19 pandemic as a financial crisis, because it certainly is a financial crisis. Welcome, Michael. Again, here's the grading. First week, obviously, is what we're doing today. Next week, we're going to talk about the Federal Reserve and the conduct of monetary policy. So read chapters 2 and 3. Then August 25th, talk about interest rates and bond prices. September 1, we're going to talk about financial regulations, and we're also going to have a guest lecturer. I'll go through those folks in a little bit, and we'll do a quick review for the exam, and then your first exam is September 8th. Then we're going to pivot and talk about financial institutions. First and foremost, commercial banking. Second, since commercial banking really is the conduit of monetary policy for the Fed, we're going to talk about risk management of financial institution. We're going to have a guest lecturer who's an expert on that topic. September 29th, we're going to talk about insurance companies and pension funds and their critical parts of the economy. Also a guest lecturer from a friend of mine who runs the pension at Textron. And October 6th, we're going to talk about investment banking and investment management. And then we'll review for exam 2. That's when the financial crises presentations will begin. October 3rd is the second exam. And then we're going to talk about the global financial crises on October 20th. October 27th, we'll talk about bond markets. We'll also have a guest lecturer on how U.S. corporations access bond markets and the primary markets. November 3rd, we'll talk about equity markets. We'll have a portfolio manager from a global value equity firm called Altrinsic Global Advisors, my friend John DeVita. Chapter 10, November 10th, we'll talk about derivatives markets, essentially futures and options. And the 17th is going to be your final exam. All right. Okay. Let me share my screen again. So here are the guest lecturers. FinRegs, my friend Andy Blocker. You're going to really like him. He's very entertaining. He's the managing director of public policy for Invesco, which is a $1 trillion asset management firm in Atlanta. Andy has a lot of experience on Capitol Hill. He's going to talk about how, about regulation and also about the role that he plays trying to influence public policy makers on financial regulations. Andy spent a long time on Capitol Hill. He actually was the head of congressional relations for President Clinton. So he's good. Trust me, he'll be a lot more fun than I am. On September 22nd, Fran Reed, who is a managing director in the financial institution group at Wells Fargo, he's going to talk about a lot what's happened since Dodd-Frank and how financial institutions risk manage themselves. September 29th, Charles Van Vliet, who is the chief investment officer of Textron, about $14 billion of assets. He's going to talk about his pension plan and asset allocation, the kind of critical decisions that he makes on a daily basis. Then my friend Brian Owens is going to talk about how U.S. corporations access capital markets and raise funds in the primary market. He is a managing director in the investment grade syndicate desk at Wells Fargo Securities in Charlotte. And then on November 3rd, John DeVita, who's a portfolio manager, will talk about how to manage equity portfolios, and in particular, his expertise, which is value investing. And we'll talk about the difference between value investing and growth investing and others in the equity class. So now it's my turn to be quiet, and I get to hear a little bit about all of you. And so, and I'll start. You can see the questions that I want you to answer for me, so I can get to know you. Obviously, your name, where you're from, what year and major, why you took this class, and maybe the best and worst thing that has happened to you as a result of COVID-19. So I'll start just to kind of guide you through what I'm looking for. I'm Tom Kushner. I'm originally from Brooklyn, New York, although I live in New Canaan, Connecticut, not too far from you all. I graduated in 1986 from Fairfield University. I'm taking this class because I'm teaching it. And the best and worst thing about COVID-19 for me, the best thing was for 4 months, we have teenage kids who are either out of college or in college. It was actually nice for the first time in a long time that we were all together for 4 months. Not always easy, but it was a lot of fun. And I would say the worst thing about COVID-19 for me is, essentially, I'm a relationship manager, I'm a salesperson, and I'm on the road 40% of the time, except Tuesday nights. And not being able to see my clients and not being able to interact one-on-one with my colleagues has been a kind of a real bummer. Sitting at this desk for sometimes 10, 12, 13 hours a day and not being able to get outside is not my definition of fun. So that's who I am. Why don't we start with the people who I've copied their names down, and then we'll get to the ones who have joined. But JT, why don't you take us through who you are? And unmute your mic. There you go.
I'm JT Gosweiler. I'm from South Jersey, kind of near Philly. I'm a senior. I'm a finance major. Taking this class, I really like your class. I think it was in the fall of 2019. I really enjoyed it, the way you taught the class, and so I decided to take this one. And then best thing about COVID was just being home with my family a little bit more than I was. And worst thing was we got our season canceled. The baseball team got our season canceled in the spring, right before a big trip. So that was a bummer.
Great. Thanks, JT. What about George Damaso, is it? And,
Yeah.
and by the way, please correct me if I don't pronounce last names or first names correctly.
Yeah, so my name's George Damaso. I'm from Orlando, Florida. I'm a junior. My major is finance. Why I took this class, I kind of want to work on Wall Street, and also I want to work in equities. So I know this is a big, important class. Also, it's required. And then the best thing about COVID, I'm getting to go home kind of early and seeing my family. It was nice. The worst thing about COVID was getting to go home and seeing my family for an extended period of time.
Yeah, I hear you. Mackenzie, you're up next.
Hi, I'm Mackenzie Meixner. I'm from Middlesex, New Jersey. I'm a senior and I'm a finance major. I forget who, but somebody told me to take this class because they said they thought it was great. So
They didn't say it was easy, right? They just said it was great.
no, yeah, they just said they liked it. So the best thing, it's a crazy story. So my dad actually found out he has kind of like a long lost brother. So like they just reunited, I guess. And then the worst thing is probably like JT said, like our season got canceled. I'm on the soccer team.
Mm-hmm.
So yeah.
Liam, thank you, Mackenzie. Liam, you're up.
Hi, I'm Liam Fitzpatrick. I'm from Long Island, New York. I'm a junior and I'm a finance and accounting major. Why I took this class, off of the name and the description, it seemed pretty interesting. I would say the best thing about COVID is I learned like how to longboard around. So that's a new thing I know how to do because I was just so bored. I picked it up. And then the worst thing is I really like watching sports. So having all those canceled was kind of boring.
Yep, I agree with you. Let's see. Is it Brogan?
Yeah, so my name's Brogan Hagen. I'm from Middle Village, Queens. I'm a junior and a finance major, and I took this class as part of the requirement. And the best thing that happened with COVID was that my sister came home from San Francisco when her residency was canceled. And the worst thing is that I was hardly able to work this summer.
Yep, no, absolutely. Darren.
My name's Darren Jansons. I'm from Bristol, Connecticut. I'm a junior finance major. I took this class because I've also heard a lot of good things about it on campus and whatnot. The best thing from COVID is I had more free time and I got to hang out with my family more. But at the same time, there's no sports or anything on, and it can get boring having more free time. So.
Yep. Darren, you're in Bristol, so you ever run into A-Rod when he's on ESPN?
No, unfortunately, no.
What about is it Owen? Let me just look through the class. Oh, I'm sorry. I couldn't understand my own handwriting. Omar.
Hello?
Hey, Omar, you're up. Let's see your face.
Yeah. Yeah, I'm here. So I'm Omar Tejeda. I'm actually from New Rochelle. I live like a block away from Iona. And I'm going into my senior year. I'm a finance major. I took this class, first of all, because you're the professor and I had you already. I thought you were a great professor. And because I'm just, obviously it's part of the finance curriculum, and like in the future, I'm looking to get into just like, I find the stock market and like investing overall, like all types of investing, very interesting. So that's like what I want to work in. And I'd say the best thing about COVID was that I got to like relax and be with my family, like be at home, kind of just like take a break from like everything in life and not have to like really worry about like having to do things. And then I also like went to California with my family over there. And then the worst thing was I missed all my friends from school, and like over time it kind of got boring. So like now that I'm back, it feels good.
Great. Thanks, Omar. Stephanie Wood.
Hi, I'm Stephanie. I'm from Highland, New York, and I'm a senior. I took this, I'm an accounting and finance major. I took this class because it's required one, and I took Professor Kushner in the fall of 2019, and I really liked his teaching style, and he kept us awake for night class, so it was good. The best thing about COVID was I got to intern, and I got to work by the pool most days of the summer, so that was really nice. And the worst thing was my 21st birthday was right when lockdown started, so that kind of ruined that.
Oh, wow. Gabriella.
Hi, everybody. My name is Gabriella. I'm from Nanuet, New York, but coming into college 2 years ago, I moved up in Harriman, New York. I'm a junior. My major is finance. I took this class because I think it's important to expand my knowledge in this department of finance. The best thing about COVID was spending more time with family that I feel like I didn't really get to have being away at school and stuff. And then the worst thing is same as JT and Mac. Our season was canceled, so that was sad.
So I'm sorry, Gabrielle, what sport are you involved in?
I play soccer with
Okay.
Mac. We're on the same team. Yeah, so we just got our season canceled like 2 weeks ago. It's crazy.
I know.
Yeah.
It is what it is. Danny, and tell me how to pronounce your last name.
Hey, I'm Danny. You can pronounce my last name Smiley.
Smiley? Okay.
Yeah. I'm originally from the Bronx, but I lived in Yonkers for most of my life now. I'm a junior. I'm entering my junior year, and I'm a finance major. I took this class. Well, I'm taking as many finance classes as I can just because I want to expand my financial literacy and just know like as much about finance as I can. The worst thing about COVID-19 is that I lost a lot of business this summer from the family business. But the good thing is we had a lot of free time to work on my brother's house.
Well, good deal.
Yeah.
What about Jonathan?
My name is Jonathan Stone. I'm from Brookfield, Connecticut. I am a senior and my major is finance. I took this class to learn about more about financial markets. Best thing about COVID was just spending time with family, and then the worst was staying inside, not being able to do anything like work or watch sports, stuff like that.
Great. Well, this is going to be a lot more fun, I bet. Michael, is it Michael Ryan? The problem is I can't read my own handwriting.
Dyer?
Dyer, that's right.
Yeah, I'm Mike Dyer from Larchmont, New York, right next to New Rochelle. I'm a senior. I'm studying finance and economics. I took this class because I think it's one of the requirements, and also seems pretty interesting. The best thing about the whole like lockdown and everything is I picked up surfing as a new hobby. And then also the worst thing is I have to deal with my family all the time. They're getting to me. I'll tell you.
And I'm sure you're getting to your parents too.
Oh, they hate me.
Elvis.
I'm Elvis Predicaj. I'm from the Bronx. I live in Yonkers now. I'm a junior and I'm majoring in finance. I'm taking this class because I want to find out more about the world of finance, and it's also required. And the best thing about COVID was I got to do a lot of DIY projects, and I got to spend time with family. And the worst was I didn't see a lot of my friends for a couple of months.
Great. Did I miss anybody? All right, then we're gonna. So just in terms of the way the class will go, you'll come into class. We'll do a quick Kahoot review of the previous week. I'll lecture. Whether it's JT or Stephanie or Omar. If we get done ahead of 3 hours, that's okay. I'm not going to be lecturing for 3 hours. I'll probably lecture for an hour and a half. We'll take a short break, then we'll come back. Then we'll do student presentations, and then oftentimes it's 2:30, 2:45, 2:40. Today I don't expect that I'm going to hold you the whole time, but I do have a bunch of slides to sort of introduce you to what we're going to be studying. And pardon me, I do have a little script because I have some things that I do want to talk about. So here's chapter 1. But before we start on chapter 1, our country has been really rocked by protests on racial justice and racial injustice. And I thought it would be really important, since we're talking about financial institutions and markets, to maybe bring subjects to light to underscore maybe some topics of racial injustice when we talk about different institutions like commercial banks or insurers or markets. So it really is my intention to raise some of these issues so that you can learn that they are real. And we're going to talk about financial regulations, and we'll talk a lot about some of the financial regulations which are aimed at stemming the tide of racial injustice. And I'm sure many of you are very familiar with the civil rights leader Martin Luther King, and I guarantee you, almost all of you know his speech, the "I Have a Dream" speech, which was given in August of 1963, a year before I was born, at the March on Washington for Jobs and for Freedom. And the main goals of that march was a protest for a comprehensive civil rights bill and for protections for the right to vote. And 1 year later, in 1964, the Civil Rights Bill was passed, and then just a few years later after that, I think in '68, the Voting Rights Act was enacted. So that protest really did have some very positive impacts on our country. And while most of Americans focus on the dream part of this speech, which is moving, if you look at the fourth, fifth, and sixth paragraph of that speech, King presents a metaphor that really captures the frustrations of African Americans, but it's also it's a metaphor which is a financial one and is going to be very germane to what we're going to be studying in this course. So I just want to read it to you, and I think you'll get an understanding of what I'm talking about. So again, this is a speech that's one of the most famous American speeches ever, but most people think about this "I Have a Dream" part of it. But King chooses to talk about finance in terms of underscoring racial injustice at that time in 1963. I also encourage you to listen to these words, because although these were spoken in 1963, maybe not enough has been done. In a sense, we've come to our nation's capital to cash a check. Now, again, all of you, I'm sure, use Venmo. I use Zelle, but people used to cash checks. When the architects of our republic wrote the magnificent words of the Constitution and the Declaration of Independence, they were signing a promissory note to which every American was to fall heir. This note was a promise that all men, yes, black men as well as white men, would be guaranteed the unalienable rights of life, liberty, and the pursuit of happiness. These are just words from the Declaration of Independence. It's obvious today that America has defaulted on this promissory note insofar as her citizens of color are concerned. Instead of honoring this sacred obligation, America has given the Negro people a bad check, a check which has come back marked insufficient funds. But we refuse to believe that the Bank of Justice is bankrupt. We refuse to believe that there are insufficient funds in the great vaults of opportunity of this nation. So we have come to cash this check, a check that will give us upon demand the riches of freedom and security and justice. And so, look at all these financial metaphors and terms. Cash a check. Again, you guys, I'm sure, just Venmo each other. A promissory note. A promissory note, it's a financial instrument that contains a written promise by one party to pay the other party a definite sum of money, either on demand or at a specified future date. It's a bond. Promissory note is a bond. This note was a promise. America defaulted on this promissory note. A check has come back marked insufficient funds. Now, you probably don't write a lot of checks, but if you did write a check and there wasn't any money in your bank account, the bank would stamp it NSF, not sufficient funds, and send it back to you and charge you a fee. And then obviously there's an issue of bankruptcy in this. So the promissory note is a bond. A bond is a debt security. We're gonna learn about bonds, and we're gonna hear from my friend Brian Owens on how companies issue bonds. But also in Wall Street parlance, people always talk about my word is my bond, and I actually looked it up where that saying came from. It's actually in the books of Matthew and Numbers about a sacred commitment, but really it came about in the 1500s in Italy. The principal word is your bond allowed merchant traders in the late 1500s to make agreements legally binding before the advent of written pledges. And interesting enough, this is a very famous term on Wall Street. People always talk about their word is my bond. When the London Stock Exchange was created in 1801 and needed a motto, they hearkened back to this foundational promise of integrity and the Latin expression. I don't speak Latin, but that is, my word is my bond. So again, this is not all about financial institutions, markets. You get a little history lesson, a little religion, and we're certainly going to talk a little bit about racial justice as it pertains to financial institutions and markets throughout the semester. Let's see. What is the financial system? It provides for the efficient flow of funds from savings to investment, or savers to borrowers. And it does that via financial markets and institutions. And so with regard to markets, there's a mechanism for issuing new securities, which are called primary markets. And those are markets that are direct. So a company or a firm like TikTok's not a great example because it's probably going to get sold, but at some point TikTok is going to get, in the next 40 days, TikTok's going to get sold to a US corporation, and I guarantee you that US corporation may IPO it in the form of a stock initial public offering. Those are primary markets. Those are markets where the company goes to investors directly. And there's also, after that IPO of TikTok, there's secondary markets where people like you and me can interact with financial intermediaries and trade those markets. And obviously, there are a variety of financial intermediaries that stand between suppliers and users of funds, and those are financial institutions. as I mentioned, primary markets are like IPOs, initial public offerings, or new issues of debt. Secondary markets are like the New York Stock Exchange, where you and I can go and transact and buy and sell stock. The New York Stock Exchange is a financial exchange or market. It was actually created under a buttonwood tree in 1792, where 24 stockbrokers used to assemble in New Amsterdam, which was what was Manhattan was called before it was founded by the Dutch. So there used to be these 24 stockbrokers that would trade stocks outside of then 68 Wall Street. And Wall Street, this is the southern tip of Manhattan. Again, this is a financial institutions class. We got a little art here, and we got a little geography here. So this is the southern tip, or the financial district of New York. This is, if you can you see my pointer?
Yeah, we can see it.
Okay.
Like we see your mouse moving.
Let me see if I can't. So this is Wall Street. Oh, why can't I draw this? See, I guess I'm not that good with. Oh, here it is. So this is Wall Street. The reason why it's called Wall Street was because this was the northernmost part of the New Amsterdam settlement, and there was a big wall that was built there to keep out the Lenape Indians, and therefore that's how that street got the name Wall Street. According to legend, the signing of this Buttonwood Agreement, which was the founding document of the New York Stock Exchange, took place under that buttonwood tree. The street along was dubbed Wall Street, and now we just refer to Wall Street as the place where we go and trade financial markets. This is the actual buttonwood tree. So there are tons of financial institutions. We have retirement funds. My friend Charles Van Vliet's going to come in and talk about how he manages the $14 billion of assets for the employees of his company, Textron. But large retirement funds have a major impact on financial markets. The Federal Retirement Thrift, or the Federal Pension Plan for Federal Workers, has $578 billion worth of assets. California Public Employees has $376 billion of assets. So we're going to talk about pension plans and insurance companies. We're also going to talk about insurance companies. The total assets of Prudential Financial, the largest insurance company in the United States, is almost $900 billion of assets. My client number 7 is TIA with over $300 billion. Number 4, I worked for AIG. They have $525 billion of assets. We're also going to talk about large asset managers. BlackRock is the largest investment manager in the world with $6.4 trillion of assets, and Vanguard has $6.2 trillion. So we're going to talk about all the different types of financial institutions that impact financial markets and demand certain products. And other financial institutions become intermediaries in delivering them products from other institutions. And of course, we'll talk a lot about the banking industry. The largest bank in the United States is JP Morgan with $2.7 trillion that is, of assets. I work for Wells Fargo, the number 3, with $1.763 trillion of assets. So these financial institutions are huge and play a very important role in these financial markets. So there are 3 major groups that play in the financial system. There are households like me and you. There are businesses, and there are government. Each group serves a role. Households influence the economy through their wealth, through their income, through their savings and investment, and through their demand for credit. Household investment is a means of transferring funds to firms, and we'll talk about this in a second. Firms also influence the economy by investing in real production. So they'll take money from you and me and recycle it to governments or to other households. So if I have a savings account at Wells Fargo will take that money and they will lend it out. They may lend it out to governments. They may lend it out to corporations to finance their growth, or they may lend it out to other people that want to take out a mortgage and buy a home. And along the way, governments are compensated by the means of taxes and real production for the economy. So, and households are compensated by the means of the dividends that they receive, or interest payments, or capital gains. So there are users and suppliers of funds. Who can tell me, and I actually just gave you an answer, in terms of households, what ways can households supply funds to the financial system? Anyone?
In like a savings account, like a bank account?
Exactly, Stephanie. Households, you go into a bank, you establish a savings account or a checking account, and the bank, what do? They take those deposits and they lend it out. Who would be the users of funds, Stephanie, in households?
Well, I would say like a credit card or like a mortgage, like a house.
Yep, absolutely. They will lend out money to people who have, credit card debt. They will lend out money for people who need to take out a loan to buy a car or a house. So households are both users and suppliers of funds. Who can tell me how businesses are suppliers of funds or users of funds?
Could a business be a supplier of a fund by giving out bonds, like corporate bonds?
Yeah, actually, in a sense, they can, because when they issue bonds, they supply to investors a way to invest their money. But also, you could suggest that when they issue bonds, a business is also taking those funds and investing in more property, plant, and equipment, or going out and buying another company. So yeah, really good point. Businesses, when they issue bonds or issue stock, they are supplying investment products for people to buy in terms of supplying funds, and then also a user of funds. They're using that to increase the productive capacity of their firm and to hopefully ensure that their investors get a return on their money. And what about governments? How can governments supply funds, and how can governments use funds? I'll give you a hint. Congress is talking a lot about how the government should supply funds these days. They were doing it.
Like one being like the pandemic relief, and then I was gonna say like even like student loans.
Yep.
Would that be one?
Absolutely. So you're absolutely right. Supplying funds, given COVID-19 hit pretty hard and hit the hospitality industry and the lodging industry and lots of small businesses. I'll have stats on this down the road, but I think 60% of employment gains in the United States is made by small businesses. So that's why, the government came in with $3 trillion to save small businesses and to save, employees that had lost their jobs, because, small businesses are so important. I think of the 60% of job growth that comes from small businesses, and that's defined as companies that have 499 employees and less, a majority of that comes with companies that have 100 and less employees. So you're absolutely right, Gabriella. The government comes in and supplies funds in the form of unemployment benefits, like that additional $600 a month, a week that they were distributing. They also supply student loans. How do they, what are some of the uses that governments have for our funds when we pay taxes?
Urban development.
Urban development, absolutely. Trade development.
Like schools, right?
Exactly. Education. So really is no wrong answer. Again, households supply funds to the financial system at a bank by a savings account. They supply funds to the financial system by buying an insurance policy and paying a premium, and they'll get a death benefit or a health benefit down the road. Businesses will supply funds so they can buy plant and equipment, and the user of the funds is either through an initial public offering or a debt issuance, or CP, which is commercial paper, and we'll talk about commercial paper. It's a short-term debt instrument when we talk about fixed income. The government influences the economy primarily through fiscal policy and monetary policy. Monetary policy actually is influenced largely by the Federal Reserve. It's probably the most important financial institution that we're going to be focused on. We're going to spend next class on the Fed. The government can also direct and influence how businesses and household in many ways spends money or saves money. So they use tax policy to incent people to save money or invest in money by having the capital gains tax lower than the personal income tax. So it incents people to take risks. And also the financial system provides the mechanism where the funds can be transferred between suppliers and users. And again, we talked about two methods of transferring funds, being direct and indirect before, but I'll make the case again. Direct investment is sort of wholesale markets. They're larger markets, typically $1 million or more. It's where firms will raise funds directly from investors. And by the way, if you have questions, feel free to jump in. When I share my screen, I don't actually see the whiteboard. So if you're typing, I'm not seeing. But if you have a question or I'm going too fast, just pipe in. And then also indirect investment is where a financial intermediary acquires funds from savers, like I talked about earlier with insurance. You buy an insurance policy so that at your death, your heirs will get a death benefit, or you buy an insurance policy so that if you get into a car accident, the insurance company will pay for the damage or home insurance, et cetera. So indirect investment is secondary trading in financial markets, and it's also where financial intermediaries acquire funds from savers and issue new claims and then lends those acquired funds. So as an example with an insurance companies, and we're going to look at this in great detail in another lecture, when they take all those premiums from everyone, they invest a lot in corporate bonds. Because they tend to be very stable investments, and they're insurance companies are highly regulated. So they'll take your cash and they will repurpose it and buy things like corporate bonds, and to a lesser extent, depending on the type of insurance company, stocks. The primary market's the name given the process of issuing new securities. So think about the IPOs. That's where investment banks and financial institutions become very active in facilitating the issuance. We're going to talk about the IPO process, at best efforts, et cetera, in a later class. But it's a market that's on fire today. There've been a lot of initial public offerings, more to come, and as a result of interest rates so low, it has been a massive issuance of debt. And as I said, when we talk about financial markets, and in particular fixed income markets, we're going to talk about how that process of issuing debt comes about. Just to further underscore secondary markets, remember secondary markets like the New York Stock Exchange or NASDAQ or regional exchanges. It can also be electronic markets where fixed income and foreign exchange is traded. Security brokers will buy or sell at best possible prices for their clients. securities brokers will go over this in more detail when we talk about investment banks. The security brokers buy at the bid and they sell at the ask, or the sell price. The bid-ask spread is the dealer's gross profit. And we'll have some examples on ensuring to know what side of the spread you deal on. And I have a little trick to help you understand that. Investment firms also involve two markets that are related to maturity. So in fixed income markets, there are the money markets, and those are securities with maturities less than 1 year. And there's a plethora of money market securities. I'll briefly talk about them later, but we'll get into more detail in fixed income. And then capital market, which are securities with maturities that are greater than 1 year. And there have been some 50 and 100-year bonds that have been issued in the last couple of years. And again, investment banks will issue these bonds, and they'll talk to investors, and they'll find out, what sort of maturity profile that they need to help offset perhaps some risks. So as an example, 10-year treasury notes are one of the most liquid maturities in the U.S. Treasury market. And the reason why that's the case is because when banks like Wells Fargo and JP Morgan and Citibank and Bank of America go out and issue mortgages, on average, the life of a mortgage, you buy a mortgage oftentimes with a 30-year life, but on average, the real life is about 10 years. So banks and the U.S. Treasury issues a ton of 10-year treasury notes, because they know that mortgage providers have to constantly hedge their portfolio by trading 10-year bonds. So the capital market, the maturities are as a result of the dynamics in the market, but also the maturity needs of customers. So as an example, if an insurer has issued a lot of, so I'm 56 years old, it's likely that I will die at age 83. So if I bought an insurance policy today, the insurer would probably think I'm going to, I'll get close to 30 years. So that insurance, to offset the death benefit that they're going to have to pay my family potentially in 30 years, they'll likely go out and buy 30-year debt, whether it's in the U.S. Treasury market, whether it's a mortgage bond, whether it is a corporate security. So the capital markets, the maturities will depend largely on demand and the dynamics of the markets, and we'll get into more detail on that. Here's just a graph of the New York Stock Exchange. As I said, it's a secondary market. The green bar is ADV, or average daily volume. As you can see, I hope you can see, $13.3 trillion a day moves in the stock market each day. So therefore it's a pretty deep and pretty, actually, I'm sorry, it's not 13.3 trillion, it's 13.3 billion shares are traded. I don't know what the notional value is, but it's a tremendous amount. So almost, 12.5 billion shares of stock trade each day right now. And as you can see, it has risen dramatically in the last couple months. Oddly enough, since COVID hit, stocks are on fire. I don't know why, but they certainly are. And as you can see, this little green called the VIX is an indicator of fear. It's called the fear index. It measures the volatility of the stock market. And when stocks are going down, VIX or volatility is very high. As you can see in March of 20, when the stock market was down close to 35%, the VIX was at 57.7%. We're going to talk about how they figure out VIX when we talk about equities. But as you can see, on average, VIX has been, 12 or 13%, shot up to 57% in March. And that's why the stock market was down 35%. As you can see, as the stock market has rallied April into May into June, it's made up all those gains. It's a flat to positive on the year. You can see that the market has gotten more comfortable with VIX, or what they refer to as the fear index, and it's just a statistical calculation of the movement of stock prices. Again, this is a stylized example of the transfer of funds. It's in your text exhibit 1.1. As you can see, there are these, they like to talk about, your text likes to talk about these SSUs and DSUs. You'll never hear that from me. These are the folks that have the money. These are the folks that need the money. You can either go directly through financial markets, through issuing bonds or issuing stocks, or to overseas financial players, or through governments, or you can go through the secondary market or indirect financing through the sort of financial intermediaries, where a household will give a bank their savings, and the bank will take that money and lend it to corporations so they can finance growth. Again, basic financial intermediation is raising funds by issuing claims to investors, and then using funds to buy claims issued by users. Again, we talked a little bit about the whole issue of maturity and their planned investment period. We'll talk about the concept of holding period returns. By claim, largely, the longer maturities tend to be riskier securities, because if it's a bond, if there's more time, there's a higher likelihood that you might not get repaid. So shorter maturities tend to be a little bit less risky, or a lot less risky, because you get paid over 3 months or 6 months or a year, and the issue of reinvestment risk comes in. So, you can invest in long maturities, but you're going to have a little bit of risk to interest rates, because you're locking in rates over a longer period. If you invest in the shorter term, and by the way, if you put money in a savings account, you'll probably earn, 5 basis points, if that, or nothing. You also run the risk of reinvestment risk. Again, this is just a stylized example of some of the things that we've talked about with regard to financial intermediation. A policyholder will give cash to an insurance company, who will get an insurance policy in return. What do the insurance companies do to invest that premium? They'll give it to a firm who will either issue debt or equity to them, or some other securities. And it doesn't have to be even that dramatic. It can be, here's you as a depositor in a bank, giving your cash in your savings account, or keeping it in your Venmo account, and the bank sort of, wholesale distributes that cash to a local business, who, in the form of a loan, repays the interest, who then repays part of the interest back to you, and the bank retains the spread between what they pay you in the form of a CD that they've given you for 6 months or a year, and what they're charging the pizza parlor on their loan. Talk about markets and sort of institutions. Financial intermediaries really do transform claims, and that's exactly what I was talking about earlier with buying the insurance policy, paying a premium, and then the insurance company going out and trying to earn a return. Transaction costs and information costs come into the equations. Transactions costs can be very high for smaller transactions. Wholesale markets, because there's so much competition, tend to drive down the cost in terms of transactions. So as a result of the supply and demand mechanics, transaction costs can be lower. And for smaller borrowers, there's less likely, there's precise information on that pizza parlor in terms of the last example we used. So they have to, intermediaries like a bank have to charge them more, because there's a lot of unknowns. I mean, I mean, I don't know how many pizza places there are in New Rochelle, but I grew up in Brooklyn, and there was one on every corner. Like, who knew if a new pizza parlor was going to make it? Other risks also exist. These uh, uh, asymmetric information problems like adverse selection and moral hazard. We're going to talk a lot about moral hazard when we talk about the global financial crises, because oftentimes government bailouts reduce the penalty to firms. And so firms anticipate this and they take on more risk. The government agencies of Fannie Mae and Freddie Mac were blamed on moral hazard. And then adverse selection really is that some players have more information than you do. So as a pizza parlor, maybe they're taking out a loan because if they don't take out a loan, they're going to go out of business. If the bank knew that they were this close to going out of business, would they make that loan? So financial intermediaries are always trying to understand sort of adverse selection problems, and also investors are always trying to assess the issue of moral hazard. Is that going to incent more risk taking, which many people think it does? Or do they invest in certain things because they know the government's going to bail them out in the end? Financial intermediaries perform 5 basic service. The denomination, that's the whole sort of issue that I talked about earlier about what types of asset tenures they have. There's currency transformation, the flexibility in maturity. They're trying to diversify along credit risks, and they're trying to ensure that what they're doing is highly liquid for them and for their clients. This is just making the same case again, in terms of intermediaries have the ability to lower the cost of financial services because they have economies of scale. They can control the transaction cost, and they have sort of risk management expertise in terms of building out a portfolio, the types of things they do. Competition also pulls interest rates down by helping companies finance less costly. Given COVID and given the accommodation by the Fed, and we're going to talk a lot about this next week, financing is so cheap. And there's a reason why corporations have gone and have borrowed hundreds of billions of dollars every month since COVID hit. And when you lower the cost of financing, you ensure that companies can, when companies make decisions on what projects to invest in, they do, net present value calculations. Well, when you lower the interest rates, remember, an NPV calculation is a numerator and a denominator. The numerator is what you're going to earn. The denominator is interest rates. Well, if the interest, just take out your calculator. If the number in your denominator goes down lower, the NPV is going to go higher. So when competition pulls down interest rates, projects are much more profitable. So companies are more likely to invest. And investment in real assets boost the economy and boost the coffers of the governments in terms of the taxes that they can collect. Well, this all sounds great, but this is not without risk. We're going to talk about a lot of these risks. There's certainly credit risk, which is the fact that some issuers may not pay you back. Fixed income investors constantly focus on credit or default risk. They also think a lot about interest rate risk, because as interest rates go up and down, and we're going to look at the dynamics of a bond and what happens with interest rates. And Stephanie and Omar and JT, I'm sure will say, as interest rates go up, bond prices go down. Again, it's an NPV calculation. It's nothing more than that. And if interest rates go down, bond prices are going to go up. Another fairly important risk of financial institutions, I found this out in 2008 when I worked for AIG Financial Products, is liquidity risk. We couldn't sell things because people didn't know what the price was. And we had a $400 billion portfolio. And on some days, people said it was worth $200 billion, and some days people said it was worth $100 billion. And so financial institutions are very concerned about liquidity risk, their ability to turn their assets into cash. I spent 15 years in the foreign exchange market, and financial institutions manage their foreign exchange risk, because if they book profits overseas or they have to pay for items overseas, the way foreign exchange vacillates every moment, every minute, will impact profits and how costly things are. And then lastly, which we spent a lot of time in my global finance course, political risk. You know, the risk of governments or regulation to financial institutions. A lot of people will be focused on our election in terms of political risk, because if Vice President Biden is elected, it is apparent, it is clear that that taxes are going to go up. So certain industries are concerned about what that could mean for the health of their industry. Next week, we're going to talk a lot about the Fed and how they conduct monetary policy. The primary concern of the Fed early on was when inflation was a big problem, was managing inflation, and they do that by managing and targeting the growth of the money supply. The Fed uses the discount rate and the Fed funds rate, we'll talk about that, to signal what its intent is to fight inflation. Increasing the Fed funds rate to fight inflation, decreasing obviously the Fed funds to expand the economy. When COVID hit in March, the Fed dropped interest rates to zero because we've had a hit to GDP of 25%, unprecedented. This hasn't happened since the Great Depression. And so the Fed is being forward-looking in terms of a bunch of different policies, but most importantly, guiding interest rates close to zero. And they did the same and more in 2007 and 8 during the global financial crisis. You know, the U.S. Constitution, if you look at Article 1, Section 8, it enables the government to regulate the value of money and fix the standard of its measurement. In 1913, the Federal Reserve was established. This is a famous picture. Again, you've learned a little bit of history. You've seen some geography. We've talked about sociology. Now we'll talk a little about art. I have the artist somewhere. Very famous painting by Wilbur Kurtz. This is of Woodrow Wilson signing the Federal Reserve Act of 1913, which established the Federal Reserve. We're going to find, I think you're going to find when we're studying financial crises, when you're doing your presentations, that really important pieces of legislation, like the Federal Reserve Act of 1913, come as a result of really bad things that happened to the economy. The Federal Reserve Act of 1930 was established as a result of the financial crises of 1907. So whoever has that 1907 crises, this was the major response, policy response by the government. The Fed controls the money supply. M1 is all sort of coins in circulation and currency and checking accounts. Demand deposits are called checking accounts. M2 is everything plus savings accounts and small CDs, and it's a big amount. As you can see, there is $18 trillion of money circulating in the economy, 18.3 trillion as of July 20th. This is when I put this together. And as you can see, it's gone up dramatically since COVID hit. It was, call it 15.5 trillion of money sloshing in our financial system, and the Federal Reserve opened up the floodgates. And now we have in excess of $18 trillion of cash out there. And so the Fed will influence the money supply so that they can influence where they want the economy to go. If, for example, the economy was doing exceptionally well, they probably would tighten the money supply because they wouldn't want runaway inflation. In fact, there's so much cash in the system, there are very large investors that are betting that inflation is going to come back, and they're taking positions in assets that do well in inflationary environments. We're going to talk a lot about, we're going to talk an entire class about the regulation of the financial system, which is meant to protect people like you and me, to ensure that industry doesn't abuse us, and also, most importantly, to stabilize the financial system so the financial system works for us. As a result of the financial crises, as again, I mentioned in 2007, the global financial crises, we had, as a result of a Democratic president, Democratic Senate, Democratic House, the Dodd-Frank Financial Regulatory Reform Act of 2010 came out, established a Consumer Protection Agency. This is the agency that Senator Warren of Massachusetts she was the first director. Actually, she was very unpopular in Congress, even with the Democrats. And she was appointed during an interim period when Congress was on holiday. President Obama appointed her as a recess appointment. There was also this whole issue of too big to fail, TBF. Fran Reed, who's going to come in and talk about financial risk management, is an expert at too big to fail. He's going to talk about what the banks are required to do to ensure that they don't get too big, that they pose a burden on the economy like they did in 2007 and 2008. And also, these are advanced risk warning systems that have been dreamt up as a result of Dodd-Frank. Again, we're getting close. Just give me a little more time. 4 major types of financial intermediaries we're going to talk about. They're depository institutions, sort of commercial banks, thrift institutions like savings and loans and savings and banks that are owned primarily by their depositors. Credit unions, the same thing. We're going to talk about contractual saving institutions like life insurance companies, casualty insurance companies, pension funds. Those insurance companies take your money and they give you a contract in return. We'll talk about investment funds like mutual funds and money market mutual funds. And there'll be other institutions we're going to mention. Finance companies. By the way, I mentioned that I work for Wells Fargo. Wells Fargo is the largest issuer of mortgages by a commercial bank in the land. But does anyone know who the largest mortgage provider is? It's actually not a bank. It's Quicken. Quicken Finance is or Rocket Finance. They're the largest mortgage. Actually, there's a lot of concern because they're not regulated technically by the Federal Reserve like commercial banks are. Commercial banks, their prudential or their main regulator is the Fed, and Quicken Loans is just a private company. We'll also talk about some very important financial federal agencies that play an important part in the capital markets. Again, here's just a listing of the assets and liabilities of many of the major financial institutions we're going to look at. Commercial banks, their assets are the loans that they extend to businesses and consumers, the mortgages that they give out, and the liabilities, which means money they have to give back, are the borrowed funds from the Federal Reserve, the time and savings deposits and checking deposits that you all put in. Insurance policies, their liabilities are their policies, and as I mentioned, they buy corporate bonds and corporate stock. Those are their assets. Mutual funds, same thing, own stock and bonds, and their liabilities are the shares that they sell in their funds to people like you and me. And private pension funds, they invest in a whole host of assets, and their liability is that they have a contractual obligation to pay their pension obligation to their employees, not without risk. We'll find out. I love little videos, so let's take a break and let's learn how a bank works. And
you ever wonder what happens to the money you deposit at your bank? And why are they willing to pay you interest when they have to do all the hard work of keeping your money safe? Now, what if I told you the banks are artificially creating money every day? All that and more in today's episode of 5 Minute Finance.
Professor, the volume's like very low. We can't really hear it that loud. I don't know if it's just my computer.
You deposit your money at the bank.
No, it's very low on my computer too.
Yeah, I can't really hear it.
Let's see. Let me see if I can put it up. I may have, I may not have added it correctly. You know, I'll re-show this when we talk about commercial banks, because I like to put these on, but maybe I didn't add it correctly so that you could hear it, because it's coming over loud and clear for me. Okay, we'll go on. Financial markets classifications. We talked about this. We talked about the issue of primary and secondary markets. Primary is where corporations or institutions or governments go directly to investors. Secondary, where there's an intermediary. Secondary markets like the New York Stock Exchange. Exchanges and over the counter. Over the counter means a particular asset doesn't trade on an exchange, like a futures, which we'll talk about the last class, or New York Stock Exchange. Over the counter are bond markets. Bond markets are over the counter markets. They are negotiated transactions between an institution and an investor. There are public markets like the New York Stock Exchange, and there are also private markets where there are negotiated negotiated securities between an investor and a bank. Futures and options they trade on exchanges. Foreign exchange is a very large over-the-counter market. Obviously, there's a difference between international and domestic. And then we talked about sort of the money markets and the capital markets. Money markets, 1 year and below. Capital markets, 1 year and above. Primary markets, where these financial claims are first issued. Secondary markets, where these claims are resold and repriced, and the trading sets the prices and yields held by these securities. Here's equity IPO issuance this year. As you can see, in 2019, there was 886 companies that went public in the IPO market for a volume of $228 billion. And that's been pretty consistent from 2016 to 2019. And then this year already, 521 companies have gone public, raising $193 billion. You'll find that when stock markets are high, people, companies that are private tend to go public because they're trying to issue at the highest part of the equity valuation. And you can see the types of IPOs with initial public offerings, whether they are offering more of an IPO called secondary offerings, and we'll talk more about this in equities, or preferred stock, which are stocks, which we're going to talk about, that have a dividend that is set and can never change. Exchanges are physical trading floors like the New York Stock Exchange or the Chicago Board of Trade, where lots of futures get traded. OTC markets, or over-the-counter markets, are very decentralized. They often trade over electronic means. The NASDAQ is a famous OTC market. We're going to talk about futures and options in our last class. But futures markets, basically, there's a delineation between spot markets, which are immediate pricing for immediate delivery of some commodity, and then futures or forward markets. Futures contracts are standardized to form amounts and dates. They trade on an organized exchange on commodities. Forward contracts, for those in my global finance class will remember, forward contracts are foreign exchange over-the-counter contracts, and they don't trade on exchanges. Option markets, again, just real quickly, this is the ability for you to have the right, but not the obligation, to buy or sell an asset. We'll talk about this in the context of stocks. Main types of options are puts and calls. If you buy a put, it gives you the option to sell that stock. We're going to talk about the reasons why you would do that. You would buy or sell a put based upon maybe your view on the market, or to hedge out a portfolio you have. Calls are options to buy stocks, and we'll talk about how they trade. They trade on volatility, so that measure of VIX is really important when pricing options. Some options are listed on securities exchanges, and many are just over the counter. Actually, the largest market in terms of largest trading value each day is the foreign exchange market. About $6 trillion a day changes hand on any given day in Forex or foreign exchange, which involves the spot market, which is for immediate delivery. You can execute future foreign exchange transactions. We're not going to talk a lot about foreign exchange, but just know that it's the largest traded market by turnover each day. The BIS, the Bank for International Settlements, which is the central bank for all central banks, they do a triannual survey, and the last survey was in 2019, and they found that it was more than $6 trillion in volume, $6 trillion in foreign exchange volume each day. We talked about money markets, shorter maturities, highly liquid, active secondary markets, low risk because they are so short dated. And they are basically on dealer balance sheets, banks' balance sheets. They're over the counter more than organized exchanges. Capital markets, longer maturities, 1 year out to 30 years, many cases 50 years, 100 years. Less liquid as a result of the higher maturities, higher risk in most cases, and as a result, you get a higher potential yield. They are oftentimes traded in more wholesale markets, some on organized exchanges, less so for the corporate bond market, but they do trade over a lot of electronic networks. Here are, on any given day, there are 120 billion of U.S. Treasury bills, certificates of deposit. So those are very large deposits that corporations buy to invest excess cash. Commercial paper, we'll talk about that. It's where companies issue an IOU for 365 days. And Fed funds, we're going to talk a lot about Fed funds next week. But money markets are a big business. They trade pretty aggressively. As you can see, during the financial crisis, people were investing a lot in very short-dated securities because they were really concerned about the fragility of the financial system. So when markets are really concerned about risk, they tend to park their money in very short-dated investment vehicles. Capital markets. So capital markets include common stock, corporate bonds, municipals, mortgages. So as of 2019, there was $44 trillion worth of in the U.S. alone. It was $44 trillion of bonds outstanding, and that was comprised of municipal securities, 3.8 trillion. So when we sit in La Penta 101 next week, likely Iona issued some bonds that paid, and because they're a nonprofit organization, that was considered a municipal security. Municipal securities, we'll learn in more at greater length. When you own a municipal security in a city or a state, a municipality, a water district, you don't have to pay interest on the interest rate that you earn on the interest rate they pay you. The U.S. Treasury market, largest fixed income market in the world. So the U.S. Treasury has issued 16.6 trillion. I guarantee you that is close to 18 trillion today as a result of what the Federal Reserve has had to do to raise money as a result of COVID. We're going to talk about some of these federal agency securities, 1.8 trillion of bonds that trade primarily in organizations called Fannie Mae and Freddie Mac, which help support the underlying mortgage market. There's something called an asset-backed securities. That's about 1.7 trillion of bonds floating around. Asset-backs are really cool instruments. I think it was Stephanie who talked about earlier a bank giving out a credit card. Oftentimes those banks will take those credit cards and they'll monetize them. They'll take those receivables, put them in a bond, structure it such that an investor can buy those cash flows and they'll get immediately paid back. The bank will immediately get paid back on those credit card loans and then sell those loans to other institutions. Same thing happens with auto debt. Same thing happens with actually mortgage-backed securities, a huge market, $10.3 trillion. So when the likes of Wells Fargo and Citibank and JP Morgan go out and lend money to people like us to buy mortgages, oftentimes they'll take those mortgages and repackage them into securities and sell them to institutional investors who want those cash flows. We'll talk a lot about the dynamics of the mortgage-backed market's really important market. The fact that the Federal Reserve bought a lot of these mortgages in 2007, in my view, really helped the economy stabilize and kept people in their homes by keeping interest rates low. And then, we're going to talk about corporate bonds. Corporate bonds, almost $9.5 trillion. I'm telling you, since March, April, May, June, there's probably been about $500 or $600 billion of corporate bonds that have issued just in the last 5 months because interest rates are so low and corporations are concerned that if COVID really hits the economy badly, they need to have cash on hand to be able to pay their suppliers and invest in the future. Fixed income is not just the US, it's global in scale. The US is about almost 40% of the global fixed income market. As you can see, the EU is also a very large player. The Japanese market is a very large, and also the Chinese market is a very large fixed income market where corporations and, in fact, the US, the EU, China, and Japan is probably, that looks like around, close to 85% of the bond market. So corporations and governments issue a lot of debt to finance growth in those countries. Again, the U.S. equity market, again, it's not just the U.S. U.S. equity market accounts for about 40% of world value across the market. Surprising that the EU is not larger than all the emerging markets, but we'll have a chance to probe John DeVita on global markets since he searches the globe to find value stocks to put in his portfolio. And that's the conclusion. This week we're on Zoom. Next week some of us may be on Zoom. I hope that a majority of us will be in the classroom. Any questions or concerns you can ask now. I'll hang out for a little bit. And then if you have any questions, happy to answer them now, or if you want to shoot me an email, my cell phone number is on the syllabus. You can text me. Happy to answer anything for you, for anyone who wants to stick around for the next couple of minutes. Else, everybody else is dismissed. Question.
I just have a quick question,
Yeah.
if that's okay.
Yeah.
So I remember you speaking about it way in the beginning of class about our presentations and stuff. I can't remember if you said, do we have to stand up at our seat when we present, or are we allowed to go to the front of the classroom and use like the our PowerPoint slides and stuff like that? Like, how is that going to
Sure.
work? Like, are we allowed to use that, or?
I think it's probably best. I will check, but I would imagine, so when you go into class, you're going to see this OWL video, which also has an audio, and anyone who talks in the class, it'll pick you up. It's 360 degrees. And what I'll ask you to do is to stand at your desk. You will have sent me your PowerPoint presentation.
Okay.
So I'll drive the PowerPoint presentation. You'll talk from your desk. Everybody on Zoom and everybody in the classroom will see you. Maybe you might move a little bit closer to the OWL audio and video, but it's the classes have been set up so that You can stay at your seat. The people in the classroom will see everybody who's on Zoom. I will get very well versed in the use of the whiteboard. So I won't be using the blackboard anymore because it won't be fair to anyone who's on Zoom, because you probably won't see it that well. So I will use the whiteboard functionality on Blackboard, and then I will save those and put them on Blackboard in a file. So if you want to just go back and look at my scribblings. But I hope that answers your question. Again,
Yeah, you did.
we're gonna we'll figure this out together.
Yeah, as we go.
You bet.
All right, thank you.
You bet. Any other questions?
I have a question for the journals that are all due next week. Does it matter what topic we pick for them to hand in?
Well, no, I've assigned the topics for each of you. So if you go to,
Got it.
Let me. I can just go back to oh, actually on my presentation. If we, where is it? If we go back, so if you see your name on mortgage-backed bonds, that's your market for the year. I mean, for the first 6 weeks of class. Everyone will submit either something on mortgage backs or corporates, treasuries, munis, and equities. But for the first week, what I want you to focus on for this is define what a mortgage-backed security is. Talk about, and there's if you just do a Google search, you'll find a ton of information. Explain. I want you to, and Gabriella, you're gonna be up for mortgage backs on August 18th next week. You're gonna define what the mortgage-backed market is. And if you just do a Google search, you'll find so much information on any of these. George will tell us what the corporate bond market is. Michael Dyer will talk about the U.S. Treasury bond market. Liam will talk about munis, and Christian will talk about U.S. equities. And so for the first week, it's just to define what these markets are. And then every week after, so Gabriella, George, Michael, Liam, and Christian, you'll get to me before class, your PowerPoint presentations. You'll be getting up in class and talking, and then students will ask you questions after. And then subsequently, each week, like JT for August 25th, and Brogan, Darren, Mackenzie, and Jonathan, they will also cover those respective markets. But they're going to tell us what happened that week in those markets and what drove those markets. And they're going to give us their personal opinions of if they thought these markets will continue to go higher or go lower. And this will be a really good opportunity for us to actually follow markets that are really important, and to be able to question each other, and hopefully by the end of the first half of the semester, you'll have a really good understanding of these financial markets as we're studying them. Is that clear?
And then I just have one more question,
Yeah.
sorry, really fast. So kind of what we're talking about, can we like write that up? And also, is that our journal submission that we also have to do, or is that something?
So when you're presenting, you just need to do a PowerPoint. When you're not
Okay.
presenting, you submit the journal.
Oh, okay, all right, sorry, thank you. I'm
Alrighty.
sorry.
No
Thank you.
So just to clear it up, so like next week I'm not presenting. So do I still have to do it on US equities, my journal?
Yes.
Okay, that's fine. I just wanted to make sure.
Everybody got it? Everybody's got to do something for the first 6 weeks. Either you're presenting or you're writing a journal entry on that market.
How long should these PowerPoints be?
A couple of pages.
All right, cool.
I mean, it doesn't need to be War and Peace, but whatever is going to, underscore. It could be one page too, because it's going to be the content of what you say, and then the sort of Q&A afterwards.
Okay.
How long should it be? Like how many minutes?
Listen, 3 to 5 minutes, couple of questions, you'll be out of it in no time. And I'll have questions too. Well, listen, I'm looking forward to being in class because I know that I have 2 screens here. I have a bigger screen so I can see everything. So I often look like I'm like staring off of this space when I should be looking at you all. But I look forward to seeing many of you in class. And for those of you who are on Zoom, look forward to having you there too. I will, this PowerPoint has already been, actually, I haven't uploaded into PowerPoint, into Blackboard, but I will. And then at the conclusion of this, I will also upload the YouTube video of this class. So I hope you learned something. Get ready to learn a lot more, and looking forward to getting to know all of you a lot better.
Thank you.
Awesome. Thank you so much. See you next week.
Call me or email me with any questions.
Thank you.
You bet.
Thank you, Professor.
Thank you.
I just have one more question.
Yeah. Professor. Yep.
The journal entries, besides present them in class, do we also have to upload them anywhere, or?
Yeah, so remember, let me just share with you, I'm just going to share with you. I got to stop the share. I'm going to share Blackboard. So if you go to Blackboard,
yeah.
In the assignment section, you will see that I've put here
Okay, I see. Yeah.
the journal. So you'll just come in and here's all the information on the actual project, and then you'll come here to submit your journal.
Okay, cool.
All right.
Okay, thank you.
So we'll make it easy. Thanks, Danny.
No problem. Have a good night.
You do the same.